session 5 in a series of sessions that I've done for the group. So tonight's session is going to be on a statement of cash flows. That's mainly driven by some comments in the group around not really understanding that cash flow statement and what's required in terms of the exam for cash flows and how to work through that process. So that's almost driven by comments we've seen in the group. And then the initial idea for tonight, which is going to be sort of the second part of tonight's session, is the consolidated statement of profit or loss. So session 4 looked at the overarching principles of consolidation, and then we looked into the consolidated statement of financial position. So what we're going to do, we're going to look at the statement of profit or loss and what we need to do from a consolidated point of view there. So you can tell I'm a bit of a teacher because I've got learning outcomes. So the whole idea of tonight's session then is to give you a solid understanding of two major topics on the drafting and interpreting financial statements exam. So one around cash flow statements and the other one around consolidated profit and loss statements. So the overall objective really, if we've got one for tonight, is to understand the purpose and structure of a statement of cash flows. And then when we're looking at statement of cash flows, we're going to apply this thing called the indirect method to be able to calculate cash from operating activities. Be able to classify our various transactions, cash transactions, into either operating, investing or financing activities. Explain the purpose and principles of group accounts. So that's a bit of a reminder around what's the purpose and principles behind sort of consolidated group accounts. And then be able to, hopefully, if you follow the principles that we're going to look at, you'll be able to prepare and interpret a consolidated statement of profit or loss. Be able to identify and adjust for intra-group transactions and this concept of unrealised profit, and be able to calculate and present non-controlling interest within a consolidated statement of profit or loss. So obviously, when we consolidate the statement of profit or loss, a bit like when we consolidate statement of financial position, there's elements of that belong to the non-controlling interest. We need to be able to calculate and present that correctly on our statements. So first thing first then, why do cash flow statements matter? So we've almost got in our world of financial statements a statement of profit or loss, statement of financial position, and this concept of a statement of change in equity. So if we know what our financial position is and we know what profit we've made, why does the cash flow statement even matter? Well, it's very simple that top line on that slide, profit does not equal cash. Yeah, so there's lots of businesses that make huge amounts of profit but don't have a lot of cash. And then equally, there's businesses that have got lots and lots of cash but don't make a lot of profit. So their profit margins might be really, really small, but they've got lots of cash, big cash reserves, investors, such like. So cash flow, so accounting generally, or certainly accruals accounting, as we know, is based on when the income is earned and when the expenses are incurred. It's not about when the money's received and when the money's spent. That's cash accounting. So what a cash flow statement reveals is the organisation's real level of liquidity and also its ability to generate cash. Yeah, so cash flow statements show three things. Yeah, cash from operations, so that's the day-to-day trading. Cash that's used for investments. Yeah, and cash that's cash that you've received either from or used in that financing activity. And under IAS 7, it is required for larger companies. So larger companies are required, certainly PLCs are required to produce a statement of cash flow that shows ultimately where the cash has been generated from and also where it's been spent. So what's the structure of a statement of cash flow? So under this International Accounting Standard, IAS 7, it's a statement of cash flow. Yeah, the structure that's dictated by IAS 7 is 3 sections: operating activities, investing activities, and financing activities. Now, thankfully, the exams at AAT for the financial accounting units at level 4 follow the same format. Why would they not? It's an international standard. Why would we not follow the same standard? So we've got operating activities, investing activities, financing activities. And then on top of that, we're almost looking at the net increases, decreases in cash. Yep. So we need to know what our opening cash and cash equivalents are, and then what then closing cash and cash equivalents are. Because ultimately, what we're looking for is the net increase or decrease. So you've got the opening position, closing position. What's the increase or decrease? So if you read any books on this topic, you'll see they talk about direct and indirect methods. Now, I'm not going to talk tonight about the direct method, mainly because that's not the method that's examined in the AAT world. In the AAT world, we very much use the indirect method. Yeah, and what the indirect method does is it converts from profit before tax, yeah, into cash. Yeah. So it ultimately converting profit before tax into your cash generated from operating activities. Yeah. And what it does is it does that by removing items that affected profit but not cash, and then adjusting for timing differences ultimately in current assets and liabilities. So we're going to start with profit before tax, adjust for any non-cash items. We're going to look at what they are in a minute. Anything that's a non-operating item, yeah, and then adjust for your working capital movements. Yeah, so movements in inventory values, movements in all your other working capital, so receivables and payables. I see somebody's got their hand up. I'm just going to try and see if you can turn your mic on. Who's got obviously a question related to something. Let's see if I can get the mics on. Bear with me. Should be able to unmute yourself if I've done it correctly. Maybe not. Does everyone still see my slides, or has they all disappeared as well? Quite sure what I've done here. Don't think I muted anybody. Have I muted everybody? Bear with me. Try that. Should be able to unmute yourself now. No, right. Anyway, right. Let me move on. I don't know what's happening at my side. It's going a bit mad. So, non-cash items then. So, how do we adjust for items that aren't cash and non-operating adjustments? So, if you think about depreciation, for example, so depreciation is probably one of the greatest examples of something that affects profit, but very much is not cash. Yeah. So from a cash flow statement perspective, you need to add back in any depreciation because it's affected profit, but it did not affect cash. Yeah. Same's true of amortization. Yeah. So that again affected profit, but didn't affect cash. Irrecoverable debt, well, it affected profit. You didn't receive any money though, did you? And you didn't pay out any money. Yeah. So reduction in, by putting through irrecoverable debt, you see a reduction in profit, but you didn't pay out any cash, did you? Same's true of a loss on disposal. A loss on disposal, yeah, well, you didn't actually have to pay any money out, did you, for that loss on disposal? And then so you're going to add those back in. You're going to remove any profit on disposal. So if you sold an asset and made a paper profit for it, it's exactly that. It's a paper profit. It's not a real cash profit. So you're going to need to remove the profit on disposal. Yeah. Then when we look at working capital movements then, so they reflect the changes, don't they, in the cash that's tied up in that working capital. So what we've got on this slide, almost showing you what happens with increases in various, what's the difference between amortization and depreciation? They're almost the same thing. So you depreciate assets and you amortize things like trademarks, patents. You might, instead of depreciating a patent, you'll amortize its value over its lifetime. But they're very much the similar concept. Yeah. So working capital then. So if we see an increase, year-on-year increase in the closing inventory valuation, for example, so closing value of inventory, year-on-year, if we see an increase, that's because we've laid out cash buying inventory. So an increase in inventory, you had to pay for it somehow. Yeah. So it's a cash outflow. Yeah. If you increase receivables, yeah, see an increase in receivables, yeah, you've laid out cash. Yeah, because you've reduced the amount of cash you've got. Because if you think about if I extend more credit, yeah, so higher receivables, I don't have the money, do I? Yeah. So that's, you've outlaid more cash to extend that position. Payables, if payables increases, yeah, then you've got cash inflow, and decreases all the opposite effect. Yeah. So when we look at investing then, investing activities relate to long-term resources that the business uses to generate long-term growth. So it could be things like purchase of PPE. So if you purchase product, plant and equipment, yeah, to do that, you need to outlay cash, don't you? So you've got to outlay cash to be able to buy assets. Yeah, so purchase of PPE, which is generally all your non-current assets. Also the purchase of any intangible assets, so I don't know, software, patents, licenses, are all examples of cash outflow. Cash inflow, well, where you're going to get, from an investing perspective, cash inflows are going to come from proceeds from selling PPE. So if I sell PPE, then any cash proceeds that I receive from that are cash inflows into my business. and proceeds from selling of any investment. So if we've got an investment, let's say we own half of another company, and we sell we sell our share in that company, we've now sold an investment, receive proceeds from that, that's inflows into the business. The final type of cash flow that you can get then is from so-called financing activities. So this reflects how a company finances its operation and its investments. So cash inflows from financing activity, issuing of new shares. So if I issue new shares in my business, somebody's going to buy them, that's going to see a cash inflow into my business. Same as if we offered any form of loans from our business. So if we offered a loan note, for example, to another business, or we are a bank and we offer a loan to a customer. Well, not a loan to a customer. That's probably a bad example because that'd be operating activity. But if we offered a loan to another company, for example, so then we'd get some form of cash inflow for that. Cash outflows from financing activity, if we repay a loan that we've taken out, if we pay dividends. So remember that payment of dividends is not investing activities, so this is a common mistake. So it's not investment activity, the payment of dividends. It's a financing activity because it's financing. It reflects how you're financing your operations. And then capital element of any leases. So when you make lease, so if you've got a lease for something, you almost got interest on the lease. But you've also got the capital element of that lease, that's financing activity. So the interest is almost a standard operating expense, but the capital element of it is very much financing activity. You're paying down finance on a lease. Is it fair to say investing covers non-current assets? Very much so, yeah. So investing, as we got on there, purchase and selling of PPE, intangible assets, and selling of investments. So yeah, very fair to say it covers non-current assets. So this slide then looks at how we reconcile a statement of financial position to cash. So what we should be able to do is get the opening cash position. So we know ultimately what the closing cash position last year was. And then conceptually, if we can add a net movement to that, which we've calculated through a statement of cash flow, that should equal our closing cash position. So literally opening cash, any movements in year gets us to the closing cash position. Now that closing cash position should be the one that you've got on your statement of cash flow. And that should, if you've done it right, match to the statement of financial position's closing cash balance on the statement of financial position. And it must reconcile with the statement of financial position. If it doesn't, then something in the calculation is incorrect. So it's important. It almost shows how all the statements are linked together. So your statement of cash flow, almost takes profit to cash. Profit shown on a statement of profit or loss. Cash shown on a statement of financial position. And then almost what you've got in the middle is cash flow statement, which is explaining both sides of that equation. So it's explaining how we get from profit to cash. So a bit of an example. Now, I've almost on purpose taken the numbers out because I don't want people to focus necessarily at this point on the numbers, just on the process. So really, really high level, looking at operating cash. Now, you don't need to, for this, and it's quite key, that you don't need to memorize lots of examples. You just need to know what the pattern is. Yeah, so we're going to start with profit. Yeah, add back in the non-cash expenses, strip out any non-operating items, and then adjust for working capital. And I promise you, if you practice this enough times, enough questions, it becomes a very mechanical process, and it will absolutely start to make sense. Yeah, so we're going to start there with profit before tax. Yeah. So as it says here, start with profit before tax. Add back in depreciation. So you've got depreciation charge. So all this stuff on the right here, left. Can't remember left from me, right? All that stuff would be given to you in the question. Yeah. So you would be given profit before tax, depreciation charge, profit on disposal if there was one, or a loss on disposal if it was a loss. How much the inventory is increased or decreased by, how much receivables have increased or decreased by, and how much payables have increased or decreased by. Yeah. So the steps are as simple as start with profit before tax, add back in your depreciation charge. Yeah. So you're always adding that back in. You're going to deduct a profit on disposal. Now, if that was a loss on disposal, you would add that. So you're going to deduct profit on disposal. If it was loss on disposal, you had to add it back in. Yeah. So if it was as I say, a loss on disposal, you'd do the opposite and you add it back in. Yeah. So taking the profit on disposal off. And then if you look at what it says here, inventory's increased. So if you see an increase in inventory, it sees a decrease in the cash position. Yeah. The opposite would be true if inventory decreased year on year, then you'd add it in. Yeah, so you just do the opposite. So deduct an increase in inventory, so minus A. And receivables have decreased, so you're going to add a decrease in receivables. Yeah, you would deduct an increase in receivables. Yeah, so in this case, we're going to add in a decrease in receivables, so add in B. And then payables have increased by some amount, so you're going to add the increase of payables in. Obviously, if payables have decreased, you're going to check it out. And then ultimately you get to the very bottom line, which is the net cash from operating activities. Now, like I say, I purposely left the numbers out because you don't need to memorize the numbers. You need to memorize the process and the pattern. Yeah. So start with profit, split out any non-operating items. So non-operating items here, depreciation, profit on disposal. They're non-cash items. Yeah. So you're going to add back the non-cash items, strip out non-operating items, disposal. Yeah. And then adjust for working capital, inventory, receivables, payables, all working capital items. If you do it enough times, it becomes second nature. So some exam tips then in relation to cash flow statements. These my sort of key takeaway really is memorize the layout of a cash flow statement. Yeah. Ensure you understand how to classify the items. So what particular items relate to operating activity, what relates to financing activity, what relates to investment activity. Yeah. Make sure you treat your working capital logically. So, increase or decrease in inventory, increase, decrease in receivables, increase, decrease in payables. Make sure you can identify your non cash adjustments. Yeah, so depreciation mainly. Yeah. And then provide very clear labelled workings. When you do this in the exam, yeah, make sure that you provide clear workings, because if you've got clear workings, that will secure your marks even if the final numbers are incorrect. Yeah, and at the end of the day, you want as many marks as possible. I think it's good that you're almost given credit for the workings. So the final answers don't necessarily need to be completely correct, but as long as some of it's correct and you can see the workings, you'd be credited for that. So that's the first bit of what I wanted to look at, just in terms of cash flow statements. Second bit of what I want to look at is around consolidated statements of profit or loss. So first bit is going to almost be a bit of a reminder. So I just want to go back to two, three weeks ago when last session I did, when we talked about consolidated group accounts. So just as a bit of a reminder, group accounts provide a combined picture, don't they, of a combined business entity, essentially. So we've got what's known as a parent company and a subsidiary company. Together, they form what's known as a group. And the groups are treated as one economic entity. Now, legally, they are different entities. Yeah, so you've got two limited companies. Let's call it A Limited and B Limited. Two totally different limited companies, but A owns 60% of B, for example. Group accounts are going to treat those as one single economic entity. Yep. And the consolidated statement of profit or loss, which is what we're going to look at, is simply the parent and subsidiaries' income and expenses added together. Yeah, because what it shows is the performance of the entire group. Yeah, so at a very, very simplistic level, we're just going to add them together. However, of course, it's never that simple. Yeah, we add them together, then we make a bunch of key adjustments. Yeah. Now, there's some key terms at the bottom of the page there. So, parent, ultimately, the parent is the company that owns a share in the subsidiary. Yeah. So, in our example, A Limited owns 60% of B Limited. A is the parent, B is the subsidiary, and it's only a subsidiary if the parent has more than 50% control. So in our example, A owns 60% of B, so we do have control, more than 50%, and it's therefore considered to be a subsidiary. Now, control, when we talk about control, what we're really talking about is the power to govern policies within that business. So, generally speaking, if you've got more than 50% control, you have more than 50% of the voting rights, and therefore you control decisions made in that business because you've got the majority shareholding. Yeah. Talk about non-controlling interest. So non-controlling interest represents the shareholders in the subsidiary who aren't the parent. So the parent owns, so in our example, A owns 60% of B. Oh yeah, we own 60% of B. Who owns the other 40%? Yeah, that other 40% is what's termed as the non-controlling interest. It's the interest in the subsidiary which the parent doesn't own. And then we're going to talk a little bit about intergroup transactions. So what we mean there is that parent and subsidiary might be trading with each other, and that could be in either direction. So the parent could be buying from the subsidiary could be buying from the parent. Yeah. I'm going to talk about what we do with intergroup transactions. So, first thing we want to look at is what does the format of a consolidated statement of profit or loss look like. I don't know why we've got an and sign there. Obviously, I was away with the fairies when I put that together. So, stuff on the left then is the rough format of a consolidated statement of profit or loss. So it should be nothing that you're not used to seeing. So we've got revenue minus cost of sales is gross profit, minus operating expenses gets us to operating profit, minus financing cost gets us to profit before tax. Take off the tax, you've got profit for the year. Yeah, that's generally nothing that's what we see in standard limited company accounts, i.e. non-consolidated. The only real change with consolidation is that the final profit for the year needs to be split. Yeah, so this stuff at the bottom, which I'm trying to highlight, and I'm probably making a really bad job of, but the stuff at the bottom there, so we're going to split it into owners of the parent. So what do the shareholders of the parent company, what's their share of that profit, against how much of that profit belongs to the non-controlling interest. Yeah. So that's what it looks like. How do we actually do it? Yeah. So really high level, we're going to add the parent and the subsidiary. So we've got a statement of profit or loss for the parent and a statement of profit or loss for the subsidiary. We're going to add them together line by line. Yeah. So we add revenue together. We add cost of sales together. Yeah. We add operating expenses together. We add finance costs together. We add tax together line by line. Yep. Then we're going to remove all the intergroup sales and purchases. So if there's any so-called intercompany transactions or intergroup transactions, we are going to remove the effects of that. Yeah, because we're looking at one combined economic entity. So we don't need to know that they sold that to them and they purchased that from them. Let's get rid of all of those transactions, strip them all out. And then we need to remove any unrealised profit from the closing inventory. So there'll be a closing inventory figure for the group, which is affecting obviously the cost of sales. Yeah, so cost of sales, opening plus purchases minus closing, it's cost of sales. We're going to strip out the effects of any unrealised profit from that. And then remove any intragroup income or charges. So we'll look at what they might be. We'll strip all those out as well. And then calculate the non-controlling interest share of the adjusted subsidiary profit. So what is the non-controlling interest share of, as it says, the adjusted subsidiary profit? So we will look at a small example in a short while. So what are intragroup transactions? So, I mean, the general rule here is that because a group is one single economic entity, it does not make sense, does it, for a group to profit from trading with itself? Yeah, so if I own this mobile phone, which you probably can't see, if I sell that mobile phone to myself, it makes no sense for me to profit from it. So the same is true of a group. If a group is trading with itself, then it makes no sense to make profit. So all internal trading across that group, the effects of that should be cancelled. So we're going to remove all internal sales across the group, all internal purchases, and remove any related receivables and payables across the group. Yeah. So we don't want to see the effects of any sales or purchases, yeah, or any receivables or payable balances between parents and subsidiaries. Yeah, because we are all just one economic entity. So we're going to see no profit, no effects of trading between members of the same group. So that's the concept of intergroup transactions. We're just going to get rid of them all, strip them all out. Unrealised profit then. So what first thing I'm going to say is that AAT absolutely love testing unrealised profit. Yeah. So if unsold inventory contains profit from an intra-group sale, yeah, so we've got unsold inventory. Yeah, so inventory that so I'm just reading, sorry, question. Does it differ when the parent or subsidiary are selling or buying? From a unrealised profit perspective, yes. So their calculations are slightly different. If you look at the last session, you'll see what you need to do there. But from a stripping out of profit or loss perspective, it makes no difference what side that trading's occurring on. So it doesn't matter if the parent is buying or the subsidiary is buying. Yeah, the effects of that transaction just need stripping out completely. Yeah. So unrealised profit then. So if unsold inventory contains profit from an intergroup sale, the unrealised profit is removed. Yeah. And that's going to increase cost of sales. Yeah. So increase cost of sales and reduce the closing inventory. I'm just looking at the chat again. So when we add the parent and subsidiary company's income, do we add the subsidiary company income of 60% if the parent company owns 6%? No, you add it line for line as if the whole thing. Yeah. So if we've got, say, company A, the parent, they've got, say, £1 million of revenue. Company B, of which we own 60%, also have £1 million of revenue. Then the answer is 1 million plus 1 million is 2 million. And then we're going to make an adjustment at the bottom to say who the profit belongs to. Yeah. So exactly as you say, that's why you work out what the non-controlling interest is. Exactly that. Yeah. So other intragroup adjustments then, and I'm going to say that not a great deal of this is tested at AAT, but I think it's a good thing to be aware of. Intragroup interest. So if I am a parent company and I am loaning, let's say I'm loaning some money to the subsidiary, and the subsidiary is paying interest on that loan, then we're going to cancel the effect of that because, again, we're just lending money to ourselves. So no point. We're not going to inflate income or expenses because that's what would happen, isn't it? We'd inflate the expenses for interest that was charged to a group subsidiary, which makes no sense. Management fees. So certainly, I've worked in a world where parent companies charge subsidiary companies management fees for shared services, for example. We're just going to split that out again. Rent. So if you're the parent company is renting an office, let's say, to a subsidiary, yeah, then you're going to strip out, cancel that rent or pay that rent because it's, again, you're just charging yourself the rent. You own at least a share of that subsidiary. You're going to split the effects of that out. And then dividends that are received or paid within a group are not group income. Yeah. So again, you should be splitting that out and cancelling the effects of dividends paid within the group. Non-controlling interest then, the bit that I think is pretty well understood what it is. I think sometimes people struggle to be able to calculate what the non-controlling interest should be. So first thing we want to say is non-controlling interest is the bit of the subsidiary that you do not own, so that the parent does not own. Yeah. And from a profit and loss perspective, the non-controlling interest share is their percentage of adjusted subsidiary profit. Now, please remember, adjusted subsidiary profit, not adjusted group profit, because they don't own the group, do they? You own the group. The parent owns the group. The parent owns the parent. The shareholders of the parent own all of the parent and a percentage of the subsidiary. Yep. The non-controlling interest own the remaining share of the subsidiary. They don't own any of the group. Yeah. So they don't own the parent, do they? They own no part of that parent company, do they own? Yeah. So what we see quite a lot is people look at that non-controlling interest and they say, well, group profit were £5 million, and the non-controlling interest is 25%. So it's 25% of 5 million. Yes, which, what, 1.25 million, which is not, because they're not entitled to any of the profit that's generated out of the parent company, only the share they don't own of the subsidiary. Yeah. And then the other thing is to say that the non-controlling interest is calculated after all adjustments. Yeah, not on the subsidiary's original profit. Yeah, so what was showing on the subsidiary's profit and loss, yeah, it's not a straight, in this case, 25% of that. Yeah, it's 25% of the adjusted subsidiary profit. So I'm just looking at Nicola's question. So, difference between retained earnings when subsidiary is purchased, retained earnings, profit at date of statements, percentage of the difference. It ultimately, yes, but then there's all those adjustments that you need to make along the way as well. Yeah, but yes, you're the point you're making is correct. Yes. And then shown right at the bottom of your consolidated statement of profit or loss, you are going to show what profits attributable to the non-controlling interest and what's profits attributable to the parent. And that should add up to profit in year for the group. So what I've got is a mini example, and it is just a mini example. This is not a full scale, massive, great big example. We've got parent profit of 500k, subsidiary profit of 200k, unrealised profit of £6,000, intragroup sales of 50,000, and a non-controlling interest of 25%. What do we do? Well, we literally take $500,000, yeah, add the 200,000. Yep. So we've got 700 grand, haven't we? Yeah. So that's going to equal 700. 700k. Yep. So that's step one, add profits. Yep. Step two, remove intergroup items. So in this case, we're going to take off, yeah, 50k. Yeah, getting us to 650. Yep, so that's remove the intergroup items. Deduct the unrealised profit. So unrealised profit 6k. So we take 6k off of here. We're now at 644. Yep. And then calculate what the non-controlling interest is. So that ultimately there is the profit, the group profit. Yep. And we're going to calculate the non-controlling interest. Can you work out the non-controlling interest of the sub as a balancing figure? Yes, absolutely can. Yeah. So now we need to, yeah. So this just highlights what the flow is, yeah? So you're now going to, so the flow is add your profits, cancel any intergroup items, adjust for any unrealized profit, and then split it, yeah? The sequence remains the same regardless of what the numbers are, yeah? Exam tips then. So things that I think you should be able to do, or some things that you need to sort of learn along the way. Learn what the pro forma looks like for the statement of consolidated statement of profit or loss. So that's, revenue, cost of sales, gross profit, and operating expenses, yeah, and so on and so forth, right the way through. Be able to work through the process step by step. Make sure you understand what the adjustments are, label the adjustments. Be able to apply your unrealized profit correctly. Be able to calculate your non-controlling interest using the adjusted profit. Now, again, you can score really strong marks just by following the process, even if the answer's not completely correct. Yeah. It's a lot of it is about that process, and if the examiners can see you're following the process, even if the numbers are slightly wrong, you will score quite strong marks across the task. Yeah.